Hello and welcome to the Tax Roundup for December 2013. And the new Parliament sat during the month and started the process of repealing taxes. The government has also been very busy looking at all the tax legislation that's currently sitting before Parliament. Adnan and Sibai explains the outcome.
Well, the government's looked at all the tax changes currently before Parliament that haven't been enacted and finally started to clean them up by making a list of changes that it will enact, changes that it will scrap, and changes that it will put on the shelf to think about later. Among the changes they'll be keeping is the scrapping of the net medical expenses offset, the improvements to the tax consolidation regime, and they'll actually be also removing the R&D tax offset for large companies with turnovers of $20 billion or more. Among the things that will not proceed is that the self-education cap of $2,000 will not apply. Good news is we'll be able to claim self-education expenses unfettered, and also the proposed tax on superannuation pension income above $100,000 is also not going to proceed. And of course, Kevin Rudd's announcement during the election campaign that the statutory method for car fringe benefits will be scrapped, that of course won't proceed. But of course that one didn't make it past media release. There were a few things we did expect to see on that list but didn't make it. These include the changes to the franking credit holding period rules and the CGT consequences of earn-out arrangements. They didn't make it to the list. Finally, the government has said that they'll review the effectiveness of the Division 7A rules and the taxation of trust regime, but they said that they'll put those on a shelf and look at them a little bit later.
The ATO have also been very active this month. They've released a controversial new taxpayer alert on partnerships of trusts, targeting lawyers and accountants. Mike Carruthers explains what to look out for.
Now, one of the big news items this month, especially for accountants, is the ATO's Taxpayer Alert 2013/3 dealing with arrangements or business structures for partnerships of trusts. Now, this is a fairly common structure used by especially accountants, lawyers and other professionals, and the ATO is basically firing a bit of a shot across the bows, warning people who are using those structures that the ATO will be investigating the tax implications around that. Now, it seems like the ATO have their sights set on a few very specific issues when it comes to partnerships of trusts, and certainly there's no problem with using that as a business structure, but the ATO just wants to make sure that particularly certain areas are being looked after properly. Now, one of the things that there's a bit of a concern about is where the principals, the individual principals of the firm, are being paid a less than market rate salary. The extra profit that basically would have been their salary is then being distributed through the partnership structure through to family discretionary trusts, and is then being split with the family members, bucket companies, other related entities of the principal who actually did the work. So that's the first area of concern. One of the other areas the ATO wants to have a bit of a look at is where there's been a restructure. So where it wasn't originally a partnership of trusts, but where the partners were the individuals originally, but a restructure has occurred. So rather than the individual being the partner, we've now got their family trust as the partner. The ATO, I guess, has a concern that maybe the CGT implications of that restructure weren't picked up correctly, and also whether documentation, whether the arrangement is actually even legally effective. Was there a declaration of trust in relation to the partnership interest in the first place? If so, was an appropriate market value calculated? Were the CGT discount, small business concessions applied appropriately? So that's one of the other areas that the ATO wants to have a look at. Now, as I said, it doesn't mean you can't use these structures, doesn't mean they won't be effective. The ATO is certainly not saying that they want to clamp down and get rid of these structures, but it is a real warning to taxpayers, especially professional firms using this type of structure, that the ATO will be looking into these structures over the coming months and coming years. So, a bit of a warning. Make sure that basically you've got things in order, and now would be the time to be doing a little bit of work just to check that there's nothing that stands out as potentially being subject to a fair bit of risk.
We'll keep you posted if we hear anything new on that particular taxpayer alert. The controversy continues, however, in tax rulings this month, with the release of a new Division 7A ruling looking at marriage breakdown and payments to companies. Mike Carruthers explains.
Now, one of the draft rulings that's been released by the ATO over the last month is TR 2013/D6, and in some cases there's a little bit of a surprise element to this ruling for some people. Now, what this draft ruling talks about is a situation where you have a couple whose marriage or relationship is breaking down, and there's a private company involved in some way, and either the court has ordered the company to make a payment to one of the former spouses, or the court has made an order compelling one of those people to then arrange for the company to make a payment or transfer property to one of the individuals. Now, the issue that the ATO looks at here is whether the payment or the transfer of property that's made by the company to the individuals would be treated as a dividend, either as an ordinary dividend under Section 44 or through Division 7A, so a deemed dividend. Now, the ATO splits the draft ruling up into a number of different components. Firstly, confirmed where we've got a transfer to an actual shareholder of the company, then it'll simply be treated as a dividend. So don't even have to get into Division 7A. There'll be a dividend, can potentially attach franking credits to that dividend, but there will be tax implications for the shareholder who receives the money or the property. Now, when it comes to a payment of money or a transfer of property to someone who is not a shareholder of the company, but is an associate of a shareholder, and that could be a spouse, former spouse, then we're not dealing with a dividend, but we're falling into Division 7A territory. And the ATO, in summary, says that either a payment of money or a transfer of property would trigger Division 7A. Now, the area where this will probably be a little bit controversial and potentially change what people thought originally was there is an exception within Division 7A, which some people, and in certain private rulings, the ATO indicated could apply when cash payments were made by a company to a spouse or a former spouse as part of marriage breakdown under a court order. Now, the ATO in this draft ruling is saying that exception won't apply and can't apply in this case, and there's a number of reasons for that. But as I say, the warning is that there might be situations where people have been advised, even by the ATO in the past, that exception could apply and could prevent Division 7A from being triggered. Now, this is a draft ruling, remains to be finalised just yet, so we'll see what happens when the final ruling is published. But just be aware of that there is a little bit of a tinkering there. It is a little bit different to potentially what the ATO have told some people in the past.
In cases this month, Adnan takes us through a case looking at that notoriously difficult area of the deductibility of legal fees.
This is an interesting case that looks at the deductibility of legal fees. It is always hard to find the fine line between deductible legal fees and private in nature or non-deductible legal fees. This case looked at a taxpayer's deductions for legal fees for defending against a banning order placed on them by ASIC from providing financial services, and also defence against criminal charges of insider trading. In both instances, the courts recognised that there was a connection to the income-producing activities of the taxpayer. However, they were both capital in nature because they defended the taxpayer's right to carry out those services, and for that reason, they weren't deductible.
And that's the tax roundup for December. Don't forget, if you're a member of Knowledge Shop, you can download the full tax roundup from the Knowledge Shop website. It also includes a fuller summary on that taxpayer alert on the Partnership of Trusts. If you're not a member of Knowledge Shop, do something positive for yourself before the new year and give us a call and take a tour of what the service actually offers. You can give Ray a call on 1800 800 232 or just have a look at the website knowledgeshop.com.au. See you in the new year.